Hello everyone and welcome to this Specialist Trading presentation. This is Stephen Primo. I am the president and founder of Specialist Trading, and I'm also going to be your teacher and your mentor for this upcoming series, this upcoming Elite Stock Traders College. In fact, I want to welcome you all for joining us. This is our very first stock trading college that we've ever offered. We've had colleges before in the E-mini and the Forex markets, but as I stated, this is the very first time we're going to be giving our strategies and our tips and techniques and teaching people along the way on how to exactly trade stocks. So once again, welcome to all the people for joining the Elite Stock Trading College. This is week one. Now, I see that we have a lot of people that have actually been members, former members before. Perhaps they've purchased a strategy or they're involved with the other colleges, but we also have some new members here that are brand new to Specialist Trading. And what we're going to be doing in week number one, if the old members can kind of bear with us, we're going to be going over the philosophy and just the basic guidelines of what it means to be a member of Specialist Trading. These are all the building blocks of what everything is structured on at Specialist Trading, what we're beginning to be covering in this particular week. And that's why we recorded it, because we really want you to absorb this information and know it like the back of your hand when we actually start to have the interactive webinars where we're teaching you one-on-one. You already understand and have absorbed the philosophy and all the knowledge that I'm going to be teaching you that, as I said, make up the backbone of what Specialist Trading is. So for those of you who are old members, this is kind of going to be a review of what you already know. But for the new people here, for this particular week, we've recorded it so that you can study this and listen to this video as often as you like. Because once again, everything that we'll be teaching or mentoring you along the way is built off of these building blocks that we're going to be discussing in week number one. So feel free to watch this video as often as you like, and then get ready for all the information we'll be passing along down the following weeks. Now, before we begin, as always, I ask that you please take a moment to view our disclaimer. We're required to show you this. I'm going to show you a lot of performance results and techniques, not only in this presentation, but in following weeks in the college. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin week one. Okay, I like to start off all of our presentations, our strategies, as well as our colleges, in this particular case the Elite Stock Trading College, with just going into a little detail on what I actually learned while trading on the floor of the exchange. Now, this is fairly different from the other presentations I give, because now we're actually talking to stock traders, and that's where I began, on the floor of the stock exchange. So my background is really in stocks, so I'm talking to people here who speak my same language. If you understand, I first started on the floor. I was down there for 16 years, and 9 of those years I was a specialist. And I know a lot of people have the misrepresentation. They think that, well, specialist, you can just print free money. It's just, it's almost like stealing. It's just easy. But really, as you've, I'm sure, heard before, I stated many times, I really had serious doubt whether I was going to continue my career as a specialist after the first year, because I just couldn't seem to make ends meet. I couldn't make any money, or whenever I did, I would just quickly give it back in 1 or 2 trades. It was extremely discouraging. And I just couldn't see there be much future for me down on the floor. When I was an assistant to other traders, it was very easy because I was basically following what they had done. But once I started trying to do it on my own, backed by a firm, it was extremely difficult, and I just could not seem to get forward. It was basically 1 step forward, 2 steps back. Whenever I'd have 3 or 4 winning trades or even winning months, I'd give it back in maybe 1 or 2 trades. So this is what I learned on the floor. And I'm sure many of you probably relate to this, but I think one of the reasons what I learned and what really caused me to be unsuccessful in the beginning was the way I was entering into trades, or the way I was deciding and to get involved into a trade. And so we've kind of characterized what the main reasons why most traders will enter into a trade. First of all, they'll say, well, the stock is too low. How many times have you heard that? We're tremendously oversold. There's no way we can go lower. This has got to be a great purchase right here, because I've never seen the stock this low. All right, so that's a great reason to get into a trade. Or just the opposite. The stock is too high. This thing has gone straight up for the last month or two. There's no way it can go any higher. It's having a parabolic upward curve. It's tremendously overbought. All the indicators are saying it's too overbought. There's no way it can go higher. I'm going to short it. All right, so that's another reason to get into a trade. Or a lot of people subscribe to these trading gurus, either through a chat room or a trading room, or either through some type of mentorship. And there's nothing wrong with that, because I'm going to be mentoring you along the way as well. But what they try to do is mirror exactly what the trading guru is doing. In other words, Every decision the trading guru does is what you're going to do in your case when you enter an order. So if he buys, you buy. If he sells, you sell. Everything he states that you should do, what he thinks about this company, that's what you do. So that's your decision process for entering into a trade, following your trading guru. Or, as I just mentioned, maybe you're a technician. I talked about how something can be overbought or oversold. Well, a lot of traders like to look at indicators, and they'll have a ton of indicators on their screen. I know because this is what I used to do. And they would say, well, something is tremendously overbought or oversold, or the indicators have all lined up. You know, everything perfectly aligns. That's my reason to enter into a trade. Okay? Now, probably the most popular reason for entering into a trade, what most stock traders like to rely on, is fundamental news. There are so many traders that love to wait and listen for a news report that's coming out, or some economic news or something about the economy or something going on in the world, or perhaps just the company's earnings, the stock's earnings that you're currently looking at. This is what their whole basis is for entering. They have to wait for these news reports to come out, a jobless claim, any unemployment numbers, anything along those lines. So this is probably the most popular reason for entering into a trade. And then lastly, TV commentators. I know you've watched them before, these guys that have the shows on TV during the day, and then after when the markets close, they're spouting what their opinion is, whether you should buy this stock, whether it's a buy, a hold, or a sell. And so this is what you use to define whether you're going to be entering or not, what their recommendations are. So these are the main top reasons, the top 6 reasons why most people will enter into a trade, regardless if you're an intraday trader, a day trader, or if you're an investor. Most people rely on these things. The one thing that we've put together and noticed, and that what I noticed because my mentors taught me, they said, Steve, what most people do is that they get their information from an outside source. In other words, they're not the thing you should be getting your information from. They're not the exact source that you should be deciding upon entering or exiting a trade, which is the chart in front of you. But what these decisions are based on are outside sources, something either news or what someone is saying in a chat room or a TV commentator. Here's a perfect example. This came out at the beginning of May, I should say, the 5th day of May, the first week of May. And it was a blogger, actually, someone on the internet that came out and said, the stock market continues to stretch higher. Is a crash inevitable? And it starts out to say the runaway move in the stock market that we have been watching over the last few months continues to stretch higher and longer. Let me emphasize again, these things always end badly, usually in some kind of a crash or semi-crash. So basically they're saying not to chase this move and that this is going to wind up terribly and that you shouldn't be involved in the markets right now because this could happen at any moment, the market crash. All right, so this came out at the very first week of May of 2013. And so if we look at the chart here of the industrials, the Dow Jones Industrials, we see that we have been having a nice run up, okay? And that report came out at the very beginning of May. And let's see what happened in the next 2 to 3 weeks. The market went up another 500 points, okay? In fact, it didn't just go up, it went straight up. Now, I know this commentator, this blogger, wasn't saying that it wasn't going to go higher, but he was saying not to get involved in the market because it could turn around at any second and it would fall out of bed and you get hurt. Now, as of this presentation right now, the market has started to go down. But we will teach you ways in which, once again, to make your decisions based off of the only source you should be listening to, and that's the market itself. So at this point, if you learn the things I'm going to be teaching you in the following weeks, there is no reason to be exiting the market just because an outside commentator says you should. All right. It's always good to be, a little careful and make sure you're studying and learning the things that I'm going to be teaching you. But at this point, the market, the most important thing that you should be listening to, was not giving us any clues as to what we should be doing. It was not telling us, okay, you should sell. Actually, we're overbought, or okay, we are going to stop going up any further. No, all it said was the market is still going up. There's no reason to do anything other than to remain long or to look for buying purchases, okay? Once again, since we have recorded this, the market has started to go down, and we will show you ways in which you could protect yourself when this happens. All right, so the main thing we're trying to say here is that forget about listening to outside sources. They can either be indicators, fundamental news, economic news, chat rooms, trading rooms. The minute you start stripping those things away, you'll get more on that road to consistency. Now, elite specialists on the floor of the exchange don't concern themselves with any of these distractions. I mean, there aren't any specialists that I knew of that were my mentors that were listening to what other people were saying or were relying on economic news or even earnings reports. They could care less. So if these elite traders who were able to generate gain after gain, profit after profit, didn't listen to these distractions, why should you? All right, you should be trying to, mimic their philosophy and their methodologies as opposed to listening to things that really haven't caused, much success in your trading as of late. Now, let's talk about an edge. This is what my mentors taught me because everyone thinks they have an edge. Everyone says, well, my edge is my strategy or my edge is my ability to interpret news. Here's what they taught me about edges because, once again, everyone thinks that they have the perfect edge. Well, if that's right, then everyone should be successful in making hundreds of thousands of dollars a year. But they said that, Steve, if you want to see what a true edge is, an edge is something that sustains your trading. Okay? And what does this mean? Well, this means that regardless of the market environment, it will still be there for you. This edge will still be providing you with nice setups, nice consistent gains. So many edges, people have a strategy or technique that will work only when the market's going up. And then the minute the market changes its tune, it doesn't work anymore. It ceases to work. Or it'll only work in certain conditions. That's not a true edge. An edge must be to be able to sustain you regardless of the environment, regardless if you're in a choppy market, regardless if you're in a trending market, regardless if the market's going up or going down. Your edge must be able to sustain you in all types of environments. They also said that an edge is something that you can rely on. So what does this mean? Well, every edge, every strategy, every tip, every technique will at some time or another go into some type of a drawdown. Another word for this is simply a slump. It ceases to work. Okay? But what separates a good edge from a bad one is basically its ability to bounce back, its resilience. So you have to have something that you can rely on that even though it's going through a kind of slump at the current moment, it's going to bounce back. It's going to be okay. And so you're not frightened. You're not starting to doubt your trading plan and thinking that, boy, this doesn't work at all. It's just something you can rely on because you've really, have confidence in it and that it's built on sound fundamental techniques, okay? But lastly, they said, Steve, the most important thing if you're looking for a true edge is an edge is consistent. So I thought, well, what does this mean, an edge is consistent? Aren't all edges consistent? No, the way you measure a consistency in an edge is through its performance, okay, and through its real world performance, not back tested, not something that really doesn't mean anything that was hypothetical, but it's true real world performance. In other words, how is it performing since you've been trading it? And the consistency is basically going two steps forward, one step back. In other words, we don't want, even though it may happen from time to time, we're not concerned about having these huge home runs. So many traders are looking for a strategy or a method or technique that will just hit these home runs each and every time, that will generate tons and tons of profits over the course of a couple of weeks or months. All right. Now, remember, I started out on the floor. I knew tons of traders who made, if not hundreds of thousands of dollars, millions of dollars in just a short period of time. And these were tremendous, tremendous gains. And guess what? They lost it all. They gave it all back. So that's not what consistency is. Consistency is not riding high in April, but then shot down in May. Consistency is this nice 2 steps forward, 1 step back approach to your trading. We know that we're going to have small losses from time to time, but they're going to remain small. And when you look at the arc of your trading career, you'll have this nice upward slope in your P&L that is going 2 steps forward, 1 step back, 2 steps forward, 1 step back. That is the true meaning of consistency. And what they taught me ultimately is that consistency will make you successful. Now, if we look towards the future, what we'll be teaching you in the coming weeks, we'll talk about my strategies. My strategies are designed to be as simple as possible. Okay, when we say simple, we're talking about anywhere between 4 or 5 rules tops in the strategies. Okay, and they are extremely, extremely consistent. All right, we're talking about real world consistency. We're not talking about looking back 10, 20 years. We're talking about how they're actually performing real worlds in the markets as we speak. All right, from time to time they will have losses, but the losses are kept to a minimum through the things we teach you. But lastly, and most importantly, my strategies will make you a part of the process. All right, that's really the most important thing here we teach at Specialist Trading. Too many traders, in my opinion, lose because they are taking themselves out of the game. All right, we talked about this before. Once you start relying on outside sources to make your trading decisions for you, whether it's an entry, an exit, or what market you're looking at, this is when you're slowly starting to take yourself out of the game. And you're basically just saying, I've given up. I don't know how to do this, so I'm going to rely on someone else to tell me what to do. All right? And that's why traders lose. The reason you lose is you've taken yourself out of the game. You're not a part of the process. What we want to do is get you back in the game. All right? Teach you the things that I've learned and used in my past 36 years that you'll be able to use and become a part of the process. Little tips and techniques to make your trading more aggressive. Techniques to make it more conservative. Little things that when you have a specific market environment, you'll be able to apply, keeping the same basic framework of the strategy, but applying these things to make you a part of the process. Okay? So that's really what it means to be consistent by making yourself a part of the process. And once you get this simplicity into your trading, that will equal the consistency. Okay, so that's really what the true meaning of success is consistency. We're not looking to hit home runs. We're not looking to be millionaires overnight with any of the things I'll be teaching you. I'm not going to promise you or guarantee anything like that, but I'm trying my best to teach you the same things that were taught to me that got me consistent down the road in my trading. My goal is to teach you, not to trade for you, not to just automatically generate signal setups for you so that you blindly take them, but my goal is to teach you how to trade with the Specialist Edge. And that's what I plan to do in this week and in the following weeks as well. All right, so let's look at the curriculum that we'll be going over in the weeks to follow. Remember, this week is specifically our foundation and the building blocks of stock trading. So we're going to give you a lot of philosophy behind specialist trading, a lot of things we believe in, and just the methodologies, because we want you to understand where we're coming from. I mean, if you think that you're coming into a college where, well, all I have to do is take Steve's signals, that's not what we're about. We want you to be a part of the process. And in order to do that, we're going to give you our philosophy this very first week. Now, in the following weeks, well, week number 2, for example, we'll be talking about stock strategy number 1. If you want a really good strategy to trade that really follows these type of swing moves, strategy number 1 is the one you will want to be trading. Now, you can apply it for intraday trading as well, but it works tremendously well with daily bars and weekly bars. In the next week, we'll cover strategy number 4, probably our most popular strategy for trading stocks to date. It generates the most signals per night. Okay, you will see tons and tons of strategy number 4. So if you like this particular strategy, it's going to be the one for you. It's tremendously popular. The great thing about strategy number 4 is that it works in any time frame. You'll see tons of signals on a daily basis. You'll see tons of signals intraday. You'll see them on a weekly basis. It's a great, great strategy. I personally trade it myself as well. The next week, week number 4, we're going to be introducing a brand new strategy. We've never really used this before. In fact, we've never issued any signals or taught this to anyone before. This is a strategy I've been currently using for the past year or so, but I feel confident enough to give it to my members and students. It's strategy number 8. And it's similar to strategy number 4 in the fact that you'll get a lot of signals, not as much as strategy number 4, but it really has the notion of many times you'll see a stock or an issue that's gone straight up and you think it can't go any higher. This is specifically designed to squeeze a little bit more gains or a little bit more momentum move out of the trade. Okay, whereas strategy 4 is looking for a momentum move at the very beginning. This is looking many times for a momentum move at the very end of its trend. Same way to the downside. So you'll be seeing a lot of these. The thing that's great about strategy number 8, I've seen that when you have these real strong downward moves, it can really catch those very easily. So it's a great stock as well to look to go short. All right, now the following week we'll be talking about my premier tool, this add-on tool, which is called the PET-D, which is short for the Primo Early Trend Detector. Now, it's not a strategy, it's not an indicator, it's just simply a tool that is designed to show you the trend many times before it's visible using other, of the more conventional modes of looking for trend. The thing that's so great about this is that you can apply this once again to any time frame, to any direction. We'll show you a lot of examples, and then there are certain different methods that you can build based off of this particular tool. Now, the tool is a color bar tool. So what it will do is with the add-on that we'll provide for you, it will actually change the color of the bars either from green to red. If it's a green bar, it will signify that we've most likely started an uptrend. And conversely, if it's red bar, for a downtrend. Once you're in these trends, you can apply different methodologies and tips and techniques, I'll go into detail, to go long or short and to build strategies off of. So it's a really great tool for discerning the early trend. We'll go over that in week 5. And then our final week, week 6, we'll give you one more of our extra bonuses. That's the Advanced Trade Management. That is a fantastic tool. Once again, it's not a strategy. It's not an indicator, but it's a tool that I'll tell you how to figure out on your own that basically warns you if your strategy is going to any type of a slump or drawdown. And how this works is that it will tell you to maybe stop trading for a while or be on the sidelines while your strategy is in a current slump. Therefore, you'll stay out of the slump entirely. You'll miss most of it, and it'll tell you when to get back in. It's a great, great tool. We'll show you how to do that. And as well, in week number 6, our final week, we'll take any last questions that you may have specifically toward your own personal needs and put it all together for you for your own particular strategy. Remember, I'm giving you all the ingredients, all the techniques, but I'm not going to make this meal, this feast for you. You're going to take these techniques and you can build it to suit your needs. So if you like the things we're teaching but you want to have them more conservatively, I'll show you how to make a conservative package to trade these building blocks. If you want to make them more aggressive, we'll show you how to do that. Remember, we're giving you the foundations to these strategies. You don't have to. In fact, I recommend that you don't trade them the most generic way. Okay? So you're going to be getting all of this. And remember, you'll also receive ultimately with all of these strategies 1 year of free signal alerts on a nightly basis. So when we see these signals, we will post them. You will be getting emails. You'll also be able to discern if you are in line with them. In other words, if you saw strategy number 8 in Apple, and then if we show that there's also that, and you'll know that you're in line. The one thing I want to mention about the signals that we will be producing for you is that they are for educational purposes only. We're not just saying this to protect ourselves, but we're really saying this because there are literally thousands and thousands of stocks. All right, we are a small company here. We don't have a huge computer that spits out all of these things. I look at these signals each and every night by hand, by chart alone, because I want to be a part of that process. Once again, I don't want to take myself out of the game just by having some computer generate where the buys and sells are on these strategies. So I literally look over hundreds if not thousands of these stocks each night to provide what I feel are the best signals for you to learn. Therefore, this does not mean that you're going to be seeing each and every signal in each and every market. That would be literally impossible for me, and I wouldn't get any sleep. What I'm going to be doing is looking over and finding the best setups that I feel will give you the best examples so that you can learn to see how these setups were generated. So this always happens with new members. They'll say, well, Steve, I saw a signal in XYZ, and why didn't you publish it? It does not mean simply because I didn't publish it that there wasn't a signal there. It only means that I'm just, with that particular strategy setup, I didn't think it was the best setup for you on this evening as opposed to something else. Remember, I don't want you to blindly take the signals that we post on a nightly basis. I just want you to see how they're constructed so that ultimately you're going to be able to do this on your own. Remember, I want you to be a part of the process. If I gave you hundreds and hundreds of signals each and every night, what good would that do? How would that help you learn anymore? Okay, so I want you to be able to ultimately, after 2 or 3 weeks or maybe even 2 or 3 months, know how to spot these like the back of your hand. All right, so that's basically our curriculum for the college. Why don't we begin? All right, so let's start out what we're going to be talking about today. Here are the different categories we will be discussing. We're going to talk about the difference between a system and a strategy, two different types of trading. I'm going to be going over concepts number 1 and concept number 2. These are the building blocks of everything we do here at Specialist Trading. Then I'll be sharing with you our 2 main edges. That's edge number 1, the buy-sell line, and edge number 2, the confirmation method. And then ultimately we'll talk about the number 1 chart pattern. This is the chart pattern that you should be looking for more than any other chart pattern when you're looking at stock charts. And then lastly, I'll give you a homework assignment. Okay, you're going to once again become a part of the process, and I will give you each and every week a different homework assignment so that I can see how well you are progressing or if you're not progressing. Don't worry, this is not something that you're going to be ridiculed or we're going to discuss in class what someone sent in. I will only discuss this on a personal basis with you, but I just want to make sure you're understanding the process behind what we're teaching. So you will be getting homework assignments as well. All right, so let's talk about the first category, system versus strategy, because so many people make the mistake. They think they're the same thing. In fact, sometimes I will want to say strategy and I'll say system and vice versa, but they are 2 entirely different ways of trading. Okay, so we must understand that right off the bat. So let's define what systematic trading is. Let's talk about some of the highlights. First of all, if you're trading a system, it's 100% mechanical. In other words, you do the exact same thing each and every time, regardless of the market environment, regardless of your buying or selling, regardless of what time frame. It's the exact same thing every time. It's mechanical. There's no discretion involved. So in other words, you can't chicken out or try to alter the rules because you're messing with the system. You have to keep everything the same, so you have to stay out of this. All right. Now, with a system, because it's mechanical, you can research it and back test it. You can go back 5, 10, 20 years and see how well it performed. All right. Remember, as we stated, since it's mechanical, it's rule-based. You have to follow these rules each and every time. And because of that, you can quantify it statistically. So you can see over the years, through this following these rules and through this research and back testing, you can see statistically what the win-loss ratio is. You can see what the worst case scenario drawdown is. You can see what the winners versus losers percentages are. Okay, so you can get statistics quantified through using a system. And then lastly, a system can be traded either manually, in other words, by you personally in front of the computer, or it can be automated. Since it just has to follow rules and since it's mechanized, you don't have to be there. It can be totally automated, and you can just, have your computer or a brokerage firm do it for you. So these are the main things that make up the details that make up a system, the highlights. Let's talk about the highlights of a strategy. Okay? Now, a strategy is mechanical as well, but it's only 70% mechanical. All right? So you have to be a robot 70% of the time. Well, with the remaining 30%, you can apply discretion. All right? You can apply some type of discretion, whether you want to be conservative or aggressive. You can put your own input into the actual process. Now, it can be researched. You can look back at a strategy and research it, but it cannot be tested. And people say, well, why can't I test this? Why can't I go back 5, 10 years and back test it? Because of the discretionary element. How do you know whether you would have, 2 years ago wanted to trade conservatively? Maybe you wanted to use some of the more aggressive components. How would you know if you would have taken every trade? Maybe you would have said, you know what, I just don't feel comfortable today about taking the trade. I won't take it today. I don't like the current market environment. So you can't backtest discretion. So there's no way you can be backtesting a particular strategy. This is one of the main different things as opposed to a system. It is rule-based, though. Remember, we have a certain set of rules. You can be anywhere from 1 to 10 to 20 rules, but there are still rules that you must follow. But once again, because of this discretion, you cannot get any statistics derived from it because you can't quantify discretion. You don't know when you'll be thinking or feeling or wanting to apply discretionary tactics each and every time, so it can't be statistically quantified. And with strategies, there's manual trading only. In other words, because of the discretionary move, once again, you can't have it automated for you. You have to actually be there trading it. So you see the difference. The real difference is this discretionary element that's involved in the strategy process. And as you can see, why are we adding this discretion with strategies is because this is what makes you get involved. This is what makes you a part of the process. So from everything we've talked about before, I guess you can finally make an educated guess as to what we teach at Specialist Trading. We do not teach or promote systems. Not that there's anything wrong with systems. I have taught systems, I've traded systems, I've purchased systems myself in the years. But once again, it wasn't until I got in this road to consistency is when I started to use the foundations of strategies. So this is why I only trade strategies now, and this is why I only teach strategies. I think looking back through systematic trading and through people I've talked to, the one main reason why people like systematic trading is because, well, there are a number of reasons. I mean, one of the reasons as well is because it takes you out of the game and you're basically giving up your power and just saying, I'm kind of frightened to make my own decisions. I'll trust something else. I don't want to be a part of this. I just want to blindly enter the orders. But I think the main reason is because with systematic trading, you can back test it. You can go back 5, 10, 20 years. And that back testing will give you some type of assurance. It'll make you feel comfortable to trade it. Okay? And there's nothing wrong with that. But at Specialist Trading, we don't believe in back testing. All right? I'm going to say it again. We don't believe in back testing. Now, sure, we'll look at back testing and we'll look to see how well a strategy performed 5, 10 years down the road. But we'll take it with a grain of salt. All right? We're not going to put all our eggs in one basket and define whether we trade something through back testing. We've had people back test our strategies, which over a 2 or 3 year period of real-time results have generated gains of over 135%. But they say, but Steve, I went back years before and they were losses. They were terrible numbers. And I said, well, yeah, but we don't concern ourselves with back testing. In other words, had someone said, Steve, I looked back 5 or 10 years and your results were phenomenal. They produced gains of over 5,000%. I could care less. It doesn't mean anything. We're only concerned in what's real. We're not concerned in what's hypothetical. Okay? Now, anything in the world can be back tested or researched if you look back. All right? You'll find a number of instances where something back tested and researched really helped you go forward trading or in life because it continued that process. And you'll find the exact same amount of things that were back tested and researched that worked, really well, and then the minute it got into the real world, failed to work and stopped working successfully. In fact, went the exact opposite direction. So there's no consistency in that. Remember, we're looking for consistency. If you flip a coin 49 times in a row and 49 times it comes up heads, all right, are the odds going to be greater on that 50th flip that it'll come up tails? Okay, because for all you know, you've already come up 49 times heads. It's got to have tremendous odds that it's going to fail this time, right? No, the odds are still 50-50, all right? It's the same way we feel, in our opinion, with backtesting. You can go back and have backtesting that is terrible. You can go back and have the backtesting that is fantastic. It still doesn't give us any consistency or any hope that the future will be the same. So that's why we're even required, to tell you by law that past performance is not indicative of future results, because it's true. It's not. There's no guarantee that past performance will repeat. So if you want to backtest, if that makes you feel comfortable, we know there are a lot of traders that are fearful of trading, of taking a step, and this is what makes them feel comfortable. This is what helps them sleep at night. Then that's great. We give you a what's it called, a assurance that if that's what you need and we will support you, then fine, continue to backtest, and if it gives you the results you need to go forward, great. But we do not promote or teach that at Specialist Trading. So this sums up the difference between systematic trading and strategic trading. Now, the advantages of trading a strategy, in our opinion, since we talked about what people want to look for an advantage in trading a system, the advantages to trading a strategy are the specialist edge, which are basically your market insight is part of the trading process. See, your insight is not just taking rules and blindly following them the same way every time. And your trading ultimately will become more methodical rather than mechanical. And that's what we want. We want it to be a methodical process. We don't want to be mechanical and just blindly taking orders. All right, so let's go into concept number 1 now. These are the building blocks of what we do at everything at Specialist Trading, all of our strategies. Okay, now concept number 1 is always trade with the trend. Okay, I know you're all saying, that's it? I've heard this before. What's so big about this? Well, take it from someone who knows. When I was trading on the floor, I never traded with the trend. I would always try to pick tops and bottoms, probably the way 99.9% of all traders trade. Okay, and I would work great until it stopped working. All right, there was no consistency in it. Now I know as of this date, there are many traders that do very well trading tops and bottoms. It's just difficult to teach. All right, remember, we want to teach something that all of you can use to get on that road to consistency. We don't just want a few of you being able to discern how to do it. So there's no consistency in that. We want to be more consistent, and the way to do that is by being in sync with the trend. I always say, if you're swimming in a river and you want to get from point A to point B using the river, what's more conducive to do that? With the current at your back or swimming upstream against the current? Obviously, you want the current at your back, and that's the same way trading with the trend. As you can see, we have some examples here. A nice upward trend in AIV. It's much more conducive to look to go long this stock than it would have been to try and short it. Same thing with GLD, that's ETF in gold. As we can see here, it's been in a real sustained downward move. Would have been a lot easier just to go with it and look for places to short or sell as opposed to trying to pick a bottom in gold. All right, so that's concept number 1, the building blocks of specialist trading. Here's our second building block, concept number 2, which is always trade pullbacks within the trend. Okay, so we're not trying once again to pick tops and bottoms. We're looking for pullbacks. Now, for those of you who don't really know what a pullback is, if you're in an uptrend, which we'll show you how to define in a little bit. If you're in an uptrend, a pullback is a sell-off or a dip in price that has reached a specific level. It tells you to go long. Okay, so we're looking for a little counter move. So if we're going up, we're looking for a little sell-off, a little dip in price. All right, that's a pullback. If we're in a downtrend, the market's going down, we're looking for a rally or a blip in price that has reached a specific level telling us to go short. All right, so if the market is heading lower, if the stock is heading lower, we're looking for a bounce. That's where our entry is going to be, within that bounce. All right. Let's look back at the same stock, AIV. All right. So someone would say, okay, well, we're obviously in an uptrend. We're not going to try and pick tops and bottoms. We're only looking for these pullbacks, which would be right here. As you see, these are all definitions of different pullbacks. Now, if you want to define them individually, we have shallow pullbacks or moderate pullbacks. We have very shallow pullbacks, and many times people call this congestion or some type of consolidation, which is just another way of saying it's a very shallow pullback, meaning we didn't sell off that much. We kind of more went sideways than anything else. Here's another moderate pullback, and then here's a deep pullback. We sold off a lot before we got to the desired level. Now, if we looked at gold again, GLD, we're obviously in a downtrend, so we're looking for a little blip in price. We're looking for the stock to rally, and that's going to be our pullback, as you see here. All these circles in red were all pullbacks, and they're all, coincidentally, areas in which a signal was generated to go short, which once you learn the strategies, you'll see how you could have gotten short at these exact levels here using some of our strategies. All right, so we talked about our two concepts. Let's go to our edges now. These are extremely, extremely important. Out of everything we trade at Specialist Trading, everything we promote, it incorporates edge number one. So this is the most powerful, I would venture to say, the most powerful tip or technique we use at Specialist Trading. This is our buy-sell line, okay? The most important edge, the most important thing, in my opinion, you'll ever use in your trading. In fact, if I were stranded on a deserted island and I had only one thing I could use, one indicator, one tip, one technique, something I could use for my trading, it would be this. Couldn't use anything else. I couldn't apply anything else except one thing that I've learned in my 36 years. It would be edge number one, the buy-sell line. That's how important it is. So what is it? Well, for all you new members, it's simply the 50-period simple moving average. That's all the buy-sell line is. But let me tell you how to use this properly. All right? I want you to plot on your chart a 50-period simple moving average. And in order to use the buy-sell line properly, all you have to do is ask yourself this question before each and every trade. But you must ask yourself before you pull the trigger, before you hit the buy or sell dot or little link on your computer, you must ask yourself this. Where is price in relation to the buy-sell line? Okay? Ask yourself that right now. Where is price in relation to the buy-sell line? And here's what you'll come up with. Because if price is above, then you're only going to be looking to buy. And when I say only, I really mean only. You'll only be looking for buy setups. If price is below, you'll only be looking to go short or sell setups. That's it. I don't want you to ever look to buy something, even if it's a perfect scenario, a perfect setup on a strategy that you've learned, if it's below the buy-sell line. Doesn't matter, okay? Same thing if you're shorting. Shorting. I don't want you to short anything, even if it's a perfect setup to go short, if it's above the buy-sell line. Now, I know so many students of mine will say, well, Steve, I didn't take that short or I didn't take that long because of your rule, the buy-sell line, and it worked perfectly. You're right. Some of them will work perfectly from time to time. But remember, it's a numbers game. We're trying to be, as we stated 10, 15 minutes ago, consistent in the market. And you will have this level of consistency if you apply this simple rule. Only look to go long above the buy-sell line. Only look to go short below the buy-sell line. All right, so let's look at an example here, a real-world example in Apple. This is going towards the beginning of 2013. We were in a real sustained downward move, but guess what? We had a really nice move to the upside right here. All right, now someone, let's say, using the conventional ways for entry would say, boy, I watched the news last night, or I watched my weekly commentary on TV, and this guy says you got to buy Apple now. It just bottomed out. We made a double bottom. It's probably going to go back at least up to 600, maybe all the way back up to 700, but that's it. It's over. The company's too good. The economic news is great. So even the indicators lined up. So I'm going to buy Apple. So this is where you jump in and buy, right? And then Guess what happened? Went up for one day, and then by the next month, it's making new lows, okay? Well, how could we have used the information I'm going to be teaching you here to help us in this particular trade? Well, first of all, we always have to apply the buy-sell line, the 50-period simple moving average. We can't just look at a blank chart like this. There must be a 50-period simple moving average. We apply it, and then what do we say? We ask ourselves, where is price in relation to that buy-sell line? Price was below when we were considering buying it. So, therefore, we should have never considered buying Apple. Price was below. So guess what? This simple little tool would have kept us out of this great loss that ultimately ensued later on. How about UPS? Let's look at an example here. Now this stock was going straight up in February. It's going straight up and then it starts to roll over. Let's say some chat room or some trading room you're in. Everyone's saying UPS has to be shorted. The market has to be shorted. We've topped out. All the indicators say UPS is tremendously overbought. And in fact, some guy I watch on TV every night says you've got to short it. Okay, company's going downhill. So you want to jump in and sell. So you jump in the very next day, and guess what? In a couple of weeks, it's making new highs. What happened to all the outside sources you were listening to? Remember, only listen to one thing. That's the market. And if we apply the buy-sell line, where was price in relation to that buy-sell line? Price was above. So the market was telling you, not an outside source, that you should only be looking to go long UPS, not look to short. Once again, applying the simple tool would have saved you tons and tons of money, if not sleepless nights. Now, a lot of people say, well, Steve, how important is this? This is it? I mean, this is the kind of stuff you're going to be teaching us? I mean, I've heard other educators on presentations talk about a 200-day moving average line. That's what you should use. Or maybe even a 20-period moving average line. Well, the reason why we focus on 50, not that there's anything wrong with those other different moving averages, the reason why we focus on 50 is because we measure an edge by how well it transferred over onto any time frame in any market. So we want an edge to be able to sustain us in different environments. Now, a 200-day moving average is great for investing if you're looking at weekly or monthly bars, okay? But if you're looking at a 5-minute bar, it's really not going to help you much. It's too far away from all the action. The same reason applies to a 20-period moving average or even lesser increments. If you're looking at a 20-period moving average, well, that's great if you're looking at a 10-minute chart of IBM. But once you go to a monthly chart of IBM, it's not going to apply that well. It really won't help you. So the reason why we use the 50 is because it transfers over into different time frames, different directions, different markets. Let me show you why we mean. Remember we talked about AIV. Remember we said this is a great stock, it's in an uptrend? Well, it was easy to find out once you applied the 50-period simple moving average. See how simple it was? And then we could look for those pullbacks within this uptrend. The same thing goes for GLD. Now, a lot of people have been complaining, saying, boy, when is gold ever going to bottom out? This is amazing. It just keeps going lower and lower. Well, we're not interested. We don't care. We're only going to look to go short. Why? Because price has always been below the 50-period simple moving average. So we're only interested in looking for shorts. And if you look at trading that way, look how much money you would have made just selling off of these pullbacks. So we're not interested whether it bottoms out or whether it changes direction. Once it goes into an uptrend, then we'll start looking to be buyers. We just go with the flow, go with the current. How about a 5-minute chart? Well, here's a 50-period simple moving average. As you can see, when IBM on a 5-minute basis was going higher, it was above the 50-period. But once the stock crossed below the 50-period and had consecutive closes, guess what? The trend changed lower. We look at a tick bar of Microsoft, a 1,000 tick bar chart. The entire time, price was below the 50-period simple moving average. So you can see all the way from 35 all the way down to 34.5, you could have been looking for situations to go short. And there was a real nice situation here using, I believe, strategy number 1 where you could have gotten short Microsoft on this 1,000 tick bar chart. How about a weekly chart? Urban Outfitters. We see here that all the way back to 2012, we've been going pretty much straight up with these nice little pullbacks here, these sell-offs in an uptrend. Okay, some great buying opportunities. Why? Because for the past couple of years, we've been above the 50-period moving average of the buy-sell line. And then monthly. So many people have been concerned with Apple, and these are mainly people that are trying to make a quick buck, thinking that, boy, I'll jump in and I'll make tons of money real quickly. But what if you were a long-term investor? All right, well, a long-term investor, we're talking about 10, 20 years down the road, you're going to be looking at monthly charts. All right, so if we apply a monthly chart to Apple, and then we apply the 50-period simple moving average, we see here that just for a few short months in 2008, 2009, we have been consistently above the buy-sell line going all the way from the middle of 2009. Okay, so had you used that, there were a number of places looking at all these pullbacks you could have entered into the trade. So this is simply viewed as, this action from this past year is simply viewed as another pullback. So once a signal is generated, you can be looking for a place to enter Apple, but only on a monthly time frame. If you're looking at a 5-minute chart of Apple or a daily chart of Apple, the scene changes entirely, so you wouldn't be applying the same type of you'd be applying the same rules, but you wouldn't be applying the same strategy, because on a daily time frame, we're below the 50-period simple moving average. Now, one last thing I want to share with you. Once again, we've looked at stocks, we've looked at some ETFs, but you can also use this as a marketing tool. In other words, you can use this to see how you want to time whether you should be in the market or not. Now, remember we said the importance of the 50-period simple moving average. It is extremely powerful. But it's also powerful if we look back in hindsight, because if we recall 2008, that was probably, for a lot of traders here, a terrible, terrible time. The market really literally fell out of bed for the next year. So many people lost their jobs. So many people lost their entire investments, all of their nest eggs. Companies went under. Banks went under at the beginning of a terrible, terrible recession that we're only starting to see the light at the end of the tunnel. What if there had been some way that you could have at least sidestepped all that? Or if you were more aggressive, could have taken advantage of? Well, let's look at the INX, which is simply the symbol for the S&P 500 index. So let's look at a weekly chart. Now we see here, just from this chart here, we're below that moving average line, that green line, which is the 50-period simple moving average. But what year are we looking at? We look back to the far left here, we see that that's the beginning of 2008. So even at the beginning of 2008, in January, we were getting consecutive closes below the 50-period simple moving average. What was this telling us? It was telling us that if you're an investor, you should not be in this market. If you want to be in, the only thing you should be in is short. So if you're long, you may want to move your stops very close and maybe lock in some gains. Maybe you want to take a little bit of profit off the table. If you have some nice profits, maybe take some off. Maybe take some cash off. Or if you're very conservative, you want to exit entirely and just remain on the sidelines until price goes back up above the 50-period simple moving average. So we were given this warning in January of 2008, and we all know what happened after that. Okay? Now, if you're an aggressive trader, you could have looked at this and taken some tremendous opportunities to go short. So there's no reason why you should not be using this powerful, powerful tool. It's the most important tool we have at Specialist Trading. As I stated, if I only had one thing to use in my trading, this is what I would choose, the buy-sell line. Now, as a rule of thumb, because a lot of people always say, well, Steve, I'm following this, but I'll get a close above the 50 period, then a close below, then a close above. How do I know what to do? Well, remember, this is not a strategy. So simply because price is above or below, we're not going to buy or sell when it closes above there. That's not what this is. It's simply a guide telling you what side of the market you should be on. But from time to time, you will get these scenarios where we jump back and forth, above and below. So what you want to do is, as a rule of thumb, look for at least 2 to 3 closes above or below the buy-sell line in order to be on the right side of the market. So if you're following something and you want to, try to decide whether you should be looking to go long or short, give it at least 2 or 3 closes above or below before you decide what side of the market you should be on. All right, so let's go to edge number 2. We have the side of the market we should be on. We know the rules behind the buy-sell line. Now, how are we going to enter? Well, we use our second edge, our second most powerful edge. That's the confirmation method. And as I stated, the confirmation method is simply an entry tool, okay? Now, what we need here is a clear-cut plan for entry, once again, that's based on what the stock chart is telling you and not what an outside source is telling you. We're going back to the same theme again, where we're not concerned with what our stock guru or what some chat room is telling us or what some indicator is telling us. We're only looking at what the chart is telling us. So here's how the confirmation method works. The confirmation method is the verification that the trend has resumed in the desired direction. So this is your signal to enter the trade. A specialist always waits for his trade to be confirmed before entry. So in other words, we're waiting for confirmation that we're going back in our direction. So what does this mean? Well, here are the rules. Okay, let me show you these rules real quickly, and then we'll show you some examples of how this works. Let's say you get a buy signal in a strategy. It doesn't matter if it's one of mine, one of yours, or something you're constructing. Once you get that buy signal, after an entry signal has been given, only buy once price trades 1 to 2 ticks above the original entry bar. Okay, so rather than buy at the market, rather than place a limit well below, wait for price to trade 1 to 2 ticks above the original entry bar or the signal bar. Now, if entry does not take place on the second bar, you have the option, I didn't state this in this writing, but you have the option to continue this process with each preceding bar as long as the setup is still valid within the strategy or until the order is filled or canceled. So in other words, if price trades 1 to 2 ticks above the setup bar's high, all right, well then you will simply enter. But what if it doesn't and your strategy is still saying to go long? Well, you'll simply just track it until it does finally trade above. But we also have many strategies we teach at Specialist Trading that are just trying to catch that quick momentum move. So it's only good for maybe 1, maybe even 2 bars, and that's it. So sometimes you will see a strategy that says only buy on the next bar if it trades 1 to 2 ticks above. So it's up to you. This is just a method for using and applying. Now let's say you want to see what this looks like in the real world. Well, here's a chart. Doesn't matter what time frame or what stock issue it is, but it's going in a clear uptrend. Once we break out of this little consolidation, most traders would like to buy somewhere once it's taken off, but then look what happens. It starts to sell off. This is where we look for our entries on the sell-offs. Remember, on these pullbacks. So we'll buy if price trades 1 to 2 ticks above the previous bar. And once it finally does, that's our confirmation that the trend is going back up. In other words, that's our confirmation that the pullback has concluded. And so this is where we enter, and then most likely the trend will go up. Now, this is not guaranteed. This is not going to say that it works perfect each and every time, but it's a great tool to give you that level of consistency so that you don't just buy at the market, and then the minute you get in, it goes the exact opposite direction. That sound familiar? I'm sure so many of you, that's happened to so many times. The minute you buy or sell something, it goes the opposite way. This will many times alleviate that pressure by simply waiting for price to trade 1 tick above the previous bar's high. All right, now the same rules apply if you want to go short. You just reverse the process. If you get a sell signal, either in my strategies, one that you got from another educator, or something you're constructing yourself, rather than just simply sell at the market, sell after an entry signal has been given, but only sell once price trades 1 to 2 ticks below the original entry bar or the signal bar. Remember, if entry does not take place on the second bar, you can either negate and wait for another setup, or you can continue this process with each preceding bar, as long as the setup is still valid within the strategy, or until the order is filled or you're canceled. So in other words, you have the option to continue this process, to keep tracking it, or with, as I stated, with many of our strategies, which you'll find in this college, they only tell you to apply this process for 1 bar only. And if it doesn't happen, then we negate the setup and we look on for another setup. Now in this particular example here, well, we're using this until we get confirmation. So obviously we're in a downtrend. Rather than sell at the market, we're going to wait for this little bounce or pullback. And here's where we applied it first. Now, as I stated, many of our strategies will say if it doesn't work the first time, we're out. But others will continue to track it, such as we do here. And this is where you'd get the confirmation that you'd enter because price traded 1 to 2 ticks below the previous bar. And that's where the trend continues. Now, the purpose of waiting for confirmation is not only to get us in at the beginning of a trend, all right, not to give us confirmation that the sell-off or the bounce has concluded, but it also, many times, an extra added advantage will keep us out of bad trades as well. So this is another reason to use this confirmation technique, edge number 2. Here's an example here. Let's say we're in an uptrend and we want to purchase, but we're following all the rules. We'll say, okay, well, I'm not going to purchase until price trades 1 tick above. See, if we had bought without confirmation, we just simply said, I'm going to buy right here because this is where the support is. Say you're one of these support and resistance traders. Well, here's a nice double bottom and you're going to buy right here before it goes any lower because you think the support's going to hold. Well, had you bought without confirmation, guess what? You would have had to explain to your spouse what happened to all your investment money. But if you use the confirmation method, well, guess what? You never would have entered into the trade because we never traded one tick above the previous bar's high. So the confirmation method not only saved you a lot of money, but it kept you out of a bad scenario. So this is the great extra added bonus of trading with the confirmation method. Now let's look at some real world confirmation method examples. These are actual setups using the buy sell line as well as the confirmation method. Here's an example in Tiffany going back to April. We are above the 50 period. So what does this tell us? This means we're only looking to go long. Now some people, as I stated, like to trade support and resistance. A lot of people like to trade breakouts. So someone looking at this could say, well, here's some resistance right here. If we break out above that resistance, I'm going to go long. All right. Well, that's where you want to buy once it trades above there. Well, we trade above. So you jump in and you go long, and look what happens. All right. Remember, we're looking only to buy on pullbacks. We're not looking for breakouts. We're not looking to pick up tops and bottoms. We're only looking to purchase on pullbacks. So we're in an uptrend. So a pullback means a sell-off, which is basically what we see right here, a sell-off. And we'll apply this confirmation where these green horizontal lines are. We'll only buy once price trades one tick above. So far we haven't even entered the trade yet. And as long as our strategy, whether it's once again one of mine or one of yours, says it's okay to buy Tiffany, continue to apply this process until we trade one tick above, and that's your point to enter right here. So you would have entered here, roughly about 70.5, and in the next month it's up to 78.5. Just made 8 points roughly in the next month or so. How about ABX? Now we see we were kind of oscillating above and below the buy-sell line, but right here we're below. We're for a consistent amount of time below. So we want to go short. Rather than just simply sell at the market, we want to apply this pullback. Here's this confirmation method. All right, so we continue to apply as long as we feel ABX is a short, and we wait for confirmation for it to trade 1 to 2 ticks below. Now, you would have entered roughly around 38, and in the next 2 to 3 weeks, it went all the way down to 32, 6 points in your favor. Now, remember, the confirmation method is not designed to get you in at the top or the bottom. And many times it will, but that's not the main purpose. That's not the motivation why we use the confirmation method. The confirmation method is really to give us more sleepful nights. In other words, it wasn't wrong to go short ABX. It was the right thing to go short. But let's say you had shorted it right here. And then what would you have had to sit through for the following week? All this when price rose. I'm sure you wouldn't have been able to sleep at night thinking, boy, when's this going to stop? Maybe I should put an order in there and just exit at the market. See, as traders, the minute we enter a trade, we want to see it go immediately in our direction. We don't want to see it go against us at all. So that's an advantage of using the confirmation method. Not to guarantee that it will always happen, but many times, the minute you get into a trade, such as we did with Tiffany on the upside, in this example, ABX on the downside, the minute you enter, guess what happens? It goes in your direction. And so you don't have to have those sleepless nights and wonder, boy, why did I get into that trade? Many times, once again, not promised, but you'll have this consistency where many times you will, the minute you enter a trade, it will go in your favor, which is the best feeling in the world. You can look at this in any direction, in any time frame. Someone, once again, could be using this as a breakout tool, the way to go long. So they look at a monthly chart of S&DK. You would have purchased right here, and then look what happened, straight down. Well, this is where we look for pullbacks. Now, we're above the buy-sell line, so we obviously only want to buy S&DK as an investor, as a long-term investor, but we can use the same process. We'll wait for it to trade one tick above, and once it does, we would have entered roughly around 38 or 39, and as you can see, went all the way up 10 points in the following months. How about a 10-minute chart of Google? Okay, well, here's a perfect example where we're oscillating above and below the 50 period. But now we have nice consistency closing below the 50 period. So we want to go short. Rather than look at support and resistance the way a good many traders do, we're waiting for this rise in price. Okay, so rather than just sell here and then have to sit through, a half an hour to an hour of upside movement, let's just apply the confirmation method. And once we enter, many times it'll go in our direction. We won't have to worry about sitting through, losing trades. All right, so let's review our second most powerful edge, the confirmation method. Remember, as we stated at the beginning of this presentation, So many traders take themselves out of the game, either by relying too much on a system, relying too much on backtesting, relying too much on what a chat room is telling them, relying too much on indicators. Remember, to get on that road to consistency, you have to make yourself a part of the process. And how you do that is learning to listen to only what the stock is telling you. Okay? So if we want to enter or exit, we're only going to buy above the previous bar's high. All right? And if we want to go short, we're only going to sell below the previous bar's low. Now, as an extra added bonus, the confirmation method will also, not guaranteed, but many times can keep you out of losers as well by not even entering you into the trade. Why? Because we didn't trade above or below the previous bar's high or low. All right, now let's move on to something extremely, extremely important. This, in my opinion, is the #1 chart pattern. I know so many people look at candlesticks, they look at formations, they look at bull-bear patterns, they look at a lot of these head and shoulder sticky. Those are all well and good, but I believe this is the only pattern you should be concerned with. This is the #1 chart pattern for trading in any time frame and in any direction. Now, 75% of our strategies employ this #1 chart pattern, okay? 75% of our strategies. This applies to going both long and short. You can apply this in any time frame, in any bar chart, and the pattern is always in the setup bar. And people will say, well, Steve, I'm not used, what is a setup bar? A setup bar is always going to be your bar prior to entry. So in other words, when all the rules have been met and everything comes into place, that final ultimate bar is the setup bar. You haven't entered yet. Now, the bar you are entering on is the entry bar, so bar previous to entry will always be the setup bar. All right, so what exactly is this pattern that we're looking for in the setup bar? It's this. If you see a bar, it doesn't matter if this is a 5-minute time frame or an hourly or a monthly, you want to see it close in the top 25% of its range. And if you see this, well, then this is a buy setup, right? How about this? If you see a bar close in the bottom 25% of its range, regardless if it's a weekly bar or an hourly bar or a tick bar, it doesn't matter, well, then this is a sell setup. That's it. Remember I told you, we keep things as simple as possible at Specialist Trading. Now someone would say, well, what's the big deal about this? Why is this chart pattern so important? Why is this in 3/4 of your strategies as the setup bar, the bar prior to entry? Well, it's simple. Because when a price bar closes either at or near the top or bottom of its range, just the way I showed you in the past examples, it means the market is giving you a clue as to which direction it wants to go. Remember, we take our signals from the market. We're not getting our clues from a trading room, from what some guy is saying on TV, or from what our back testing is telling us. We take our clues from the market itself, what's happening in the now. That's all we're concerned about. All right, so the #1 chart pattern rule, how do we employ this? If you are going long, look for the setup bar. Remember, that's a bar prior to entry to close either at the high or in the top 25% of its range, okay? This is what we use in 25% of our strategies. Conversely, if you're going short, look for the setup bar to close either at the low or in the bottom 25% of its range. Remember, this applies to any time frame in any market. Let's look at Duke here, all right? This is a daily bar chart. As you can see, we had a really nice uptrend at the beginning of this chart here where we're going straight up basically, and then all of a sudden we hit a top. Guess what? We're going straight down. Now, if we look at the time we were going up in this obvious uptrend, guess what? There's the #1 chart pattern. You see how the majority of bars are closing in the top to 25% portion of their range. Once again, this is the market, not an outside source, but the market giving you a clue as to which direction it wants to go. So when you start seeing the majority or propensity for bar charts to be closing, it's just telling you we're going higher. Now, conversely, when we change directions, well, guess what? You didn't see so many closing in the top 25. All of a sudden, the majority of the bar charts are closing in the bottom 25%. The market is telling you something. It's giving you a clue as to which direction it wants to go. So when you start seeing these changes, you know that there may be a short-term trend change. This is a tremendous, tremendous clue that you've just learned by listening to the market. It didn't matter if this were a daily bar chart. This could just as easily have been a 5-minute chart or a monthly chart. The same clues apply. How about an hourly chart, IBM? Okay, obviously we're in a nice uptrend. Look at all the majority of the bar charts here closing in the top 25% of its range, of their range. Okay, these are hourly bar charts. If we want to look at a weekly chart of silver, the ETF for silver, SLV, obviously this has been going lower. We're in a downtrend. No coincidence that the majority of the bar charts are closing in the bottom 25% of their range. The market likes to give you clues. It's just that we've never been taught to listen to it. We've always been taught, well, I better turn on TV and see what these news guys are saying, or I better wait for the economic indicators to tell me what to do. The market is telling you what it's going to do. So it's much easier, not so time consuming, and not so difficult to figure out once you learn how to listen to what the market's telling you. Now, points to remember. This is a pattern, but it's not a strategy. Okay, so remember, we stated this is the #1 chart pattern, not the #1 trading strategy. So just because you see that, so many students, they love what they learn here in the first week, and they go, boy, I'm going to start trading this tomorrow. There's nothing to trade here. We haven't given you a strategy with rules yet. We've just shown you a pattern and all the building blocks that make up our strategies and our techniques at specialist trading. Remember, the stock chart is giving you the most important clue you'll ever get. Not an outside source, but the chart itself. As I stated in the beginning, our goal is to increase your odds for a successful trade or successful, career as a trader. There are no guarantees for winning trades. So the only thing we can do is try to put the odds in our favor by listening to the market and by getting rid of the useless noise. This is what my mentors taught me. They explained to me this is what was getting in the way of my success. I listened to every news report that came out. I followed all the jobless numbers, all the claims that were coming out, all the earnings reports. I had maybe 20 indicators on all of my screens, technical indicators telling me what to do. I was looking at Elliott Wave and sunspots, everything you could think of. I was listening to all these commentators on TV telling me what I should buy or sell. And I really cluttered up my trading tremendously. As soon as I started to strip that away and listen only to what the market was telling me, my trading started to become consistent. So let's recap. Remember, using the #1 chart pattern, 75% of our strategy signals are based off of this. All right, so many of the strategies we'll be teaching you will have this #1 chart pattern. This applies to both going long and short. You can use in any time frame, in any bar chart. Doesn't matter if we had monthly charts or tick charts. You're still looking for the same bar that either closes in the top 25 or the bottom 25% of its range. And remember, this pattern is always in the setup bar. So in other words, if you enter, the bar before you entered should have been either closing in the top 25% or the bottom 25%. All right, now I want to give you a homework assignment. It should be extremely simple, but I really, as I stated, the most important thing you're going to be learning and I hope employing in your trading, regardless if you use my techniques or if you use something that you created, is the #1 edge, which is the buy-sell line. So I just want you to give me 2 or 3 examples in different time frames, in different directions, showing me a chart with the 50-period simple moving average plotted, and then telling me what you would be looking for, okay, in that particular chart. All right, it may be different things you'd be looking for. Maybe you would be looking to go short. Maybe you'd be on the sidelines. But just tell me what you would be doing according to that one clue that the buy-sell line gives you. I want you to give me, probably 3 examples, different time frames. So maybe it can be a 5-minute, an hourly, or a weekly, a daily. But just give me some different examples, three examples tops of how the buy-sell line works, and tell me what you would be doing. You can just email this to me. It doesn't have to be sophisticated. It doesn't have to be on a Word document. Just email me a picture, a snapshot, and tell me what you do. Identify current buy-sell lines. Okay, so that's your assignment. If you're wondering what that is, just get the buy-sell line, and I want you to identify current. All right, so let's recap what we did here in this first week of the Elite Stock Trading College. We discussed what the difference is between a system and a strategy. Now, remember, there's nothing wrong with systematic trading. It's just that we don't use it or believe in it here. A lot of people that have come to my different colleges or different strategy courses have said, but Steve, I don't understand how you can't use it, how you can't believe in it. It's basically as if you walk into a restaurant and say, I do not understand why you do not sell French food here. Why wouldn't you have a French meal here? I'd say, listen, we have nothing against French food. It's just that this is a Mexican restaurant. We don't sell French food here. It's the same with system versus strategy. We have nothing against systematic trading. We just don't teach and promote that here. We don't believe in it in these terms. So if you need that to make you comfortable, then great. We support you for that. Okay, if that's what it takes to get you through the process, great. But that's not what we teach. Okay, we don't believe that past performance is indicative of future results. In fact, the government doesn't believe it either, so they require us to say that. So if we don't believe that and we're required to say that, why should we believe in backtesting? So strategic trading makes you a part of the process. You have 30% discretion involved, and there's no way you can backtest your feelings or emotions for going back 5 or 10 years. So we also talked about concepts number 1 and 2. Concept number 1, always trade with the trend, okay? We never want to try and pick tops and bottoms, and I know that firsthand what's going to happen. It's going to work great, and you'll say, I love trading tops and bottoms, and then the one time it doesn't work, you'll give everything back. So that in no way will you be consistent trading tops and bottoms. Okay, there are very few people that are able to do that consistently. So it's much easier to go in sync with the trend than it is to go against it. So we're going to trade with the trend, and then concept number 2 is we're going to look for our entry to be in a pullback within that trend. So if we have an upward trend, we're looking for a sell-off. That's our pullback. If we have a downtrend, we're looking for a bounce or a blip in price. That's our pullback to the upside. That's where we look for our setups, our signals. Now we talked about our most important edges. Edge number 1, that's your homework assignment, the buy-sell line. It's simply the 50-period simple moving average. But before you apply it, and before you pull the trigger on any trade, you ask yourselves, where is price in relation to that buy-sell line? And that should give you the answer right there on what you should be doing. Once you know what side of the market to be on, then you're going to employ edge number 2, our confirmation method. So if you get a buy signal, regardless of what strategy you're using, one of yours, someone else's, or one of mine, only want to buy if price trades 1 to 2 ticks above the setup bar's high. Okay? If you get a sell signal, just reverse it and go short when price trades 1 to 2 ticks below. And then we also discussed the number 1 chart pattern. That's where if the chart closes in the top 25% of its range, it's the market giving you a clue as to which direction it wants to go for the short term. If it closes in the bottom 25% of its range, it's the market giving you a clue that it wants to go lower for the short term. This is a tremendous, tremendous clue that the market has given you, and this is what you should be learning to listen to. And then, once again, we talked about the homework assignment, which is simply to identify about 3 current charts in different time frames employing the buy-sell line. Just simply tell me what you should be doing according to that one edge. Remember, my goal is to teach you how to trade with the specialist edge. This is the same edge that turned my way of trading around, that got me on that road to consistency. This is what I'm trying to teach and instill in all of you. In the coming weeks, I will be providing you with strategies. I will be showing you how to trade them generically as well as aggressively or conservatively. I will be sharing with you different strategies and tips and techniques. But remember, this is not simply a systematic way to trade. We don't want you to come and blindly take the signals that I post. They're only there for educational purposes. I want you to see them to learn why they were posted and what the rules were behind. Just because I didn't post a particular signal that you saw does not mean it's not valid. I'm only posting them for specific reasons so that you may learn, okay? And you can always email me with questions whether something wasn't posted or whether it was a valid signal or why was this a valid signal. But my goal, as I state here, is to teach. If you wanted to learn how to play golf because you're perhaps going to be in a friendly tournament with some friends, you wouldn't pay me to go golf for you. You would pay me to teach you through my experience what I've learned so that I could help you with your golf game. I'm doing the same thing here. That's what I'm being paid to do with you. I'm teaching you all the things I've accumulated in my 36 years. Hopefully will get you back on course and get you into consistency. Now, this was Elite Stock Trading College week number 1. Next week we'll start with week number 2, or the next presentation we have once we have decided when that will be. And we'll discuss one of our best strategies for swing trading. That's strategy number 1. Great tool we have to use to employ strategy number 1. We'll go over and show you exactly how to employ that. That's in week number 2. Should you have any questions? Now, if you have a question concerning the add-on tools, in other words, using the different tools we're going to supply you with, such as the PET-D or the different add-ons for the strategies, anything that's of a technical nature, please email my Vice President of Operations, Brett Marsh, at bretm@specialisttrading.com, or you can call him directly at 310-844-7220. Anything along the lines of teaching or education, or why was a signal posted, or I don't understand the basis behind the strategy, feel free to always email me whenever you like. I'll get back to you as soon as possible. And that's simply stephenprimo@specialisttrading.com. Okay, so anything on an educational basis comes straight to me. Anything why you didn't receive an email, anything how do you get this computer graphic to come up or something that we've given you, anything of a technical nature, forward that to Brett at brettm@specialisttrading.com. Or you can always reach us at area code 310-844-7220. In closing, I ask you to take one last look at our disclaimer. Remember, we're required to show you this. I showed you a lot of performance results using all the tips and techniques that make up the groundwork of specialist trading. This is what we covered today. But please remember that we can in no way guarantee that any of these results will be repeated in the future. As you can see, if the government requires us to say this, there is no way we can really believe that this backtesting will apply at all. So this is why we don't, in another way, approach or use anything in accordance with backtesting. So please view our disclaimer one last time. And while you're doing that, I want to thank you so much in closing here in this first week for becoming a member of our brand new Elite Stock Trader College. This is the first time we've done this with stocks, and it feels like I'm coming home because I'm finally getting to teach people where I started with the stock market, and this is where my trading turned around. So I'm starting full circle and beginning where I actually began as well. I'm going to teach you a lot of great things. All the things I've accumulated in 36 years, I will share with you. I will share with you the way I trade these different strategies and what I use for me. But ultimately, I want it to be designed to fit your persona and your nature. Okay? So in closing, I want to thank you so much for becoming a member. Thank you so much for joining. And we shall see you with the next series of educational webinars, which will be decided later. But watch this video as often as you like, and we'll see you with week 2, where we discuss strategy number 1. Bye-bye.